Hey, good afternoon, and welcome to another Thursday here in the Coachella Valley. My name is Jeff Harrison. It's a little smutsy outside. I got that from a friend. He said, yeah, the air is a little smutsy. So make sure if you're out there walking around or you're getting ready to head over to Stagecoach, it may be because there's a lot of horses on the way into town, a lot of cowboys and cowgirls. Who knows? I don't know. I apologize for being late. We had a little bit of a technical difficulty. So without further ado, I'm going to bring in our star of the show. And of course, as we all know, that is Art Alvarez with MortgageWorks. Welcome to Mortgage Minute. Hey, Art, how you doing?
Hi, Jeff. Good. How are you?
Good. Yeah, it's. Have you noticed it's a little smutsy outside?
Yeah, I was just going to say I like that term. I have never heard that before, but I think I'm going to borrow that going forward whenever we have days like this. Yeah, because out here in the Coachella Valley, it's just we're in a windstorm.
Something I'm in the east part of the valley, and we don't have any wind going out here. I know you're in the Palm Springs area. Is it windy there?
Oh yeah. And I was actually Mid Valley at lunchtime because I was at the Desert Valley Builders Association luncheon meeting where they had a economist from the National Association of Home Builders doing a presentation, and it's really blowing there.
Wow.
So, yeah.
Well, I'm sorry to hear that. I hope it clears up. We had this little dust in the air for the last 2 or 3 days. And a friend of ours who just left back to San Diego had been staying with us said, we're supposed to have some really serious winds until about midday or about midnight on Saturday. And I'm like, I hope not. Boy, that's the one thing I do not like about the spring here in the Coachella Valley, and that's the winds.
Yeah, me too, because it definitely, for one thing, it really messes up my hairdo. So.
I love it. Well, for those of you joining us live, this is Mortgage Minute, and I'm going to dip out of here. And I don't know if that's dipping. I'm going to remove myself from the screen. But in the meantime, I'm going to be on the back end. If you have questions for Art, because this is a live show, please put them in the comments, and I will put them on screen, and Art will answer them. And now, if you're watching this afterwards, and you weren't able to join us live, please put your questions in the comments and let us know. We're on Facebook and YouTube. And of course, you can always go to Art's website afterwards at mwalone.com and see it on his blog. So with that, Art, have a great show.
Okay. Thanks, Jeff. Hello, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks. We'll jump right into it, particularly since we got a late start here due to our technical difficulties. There's our rate grid. As you know, we start off by giving you an update on mortgage rates every week. And you can see there our latest rates. This was updated this morning. Unfortunately, it is true now that for conforming 30-year fixed rate, Fannie Freddie loans, we're now a little over 7%. You can see there 30-year fixed at 7.125. That, of course, affects the buy down options, the 3-2-1 and the 2-1, where we can have a first year rate at 4 1/8 or 5 1/8, depending. The 15-year loan fixed rate, actually, the rate on that has held in there. It didn't really move much compared to 30-year, and FHA VA is still holding on nicely despite these elevated bond yields, and we can still do both FHA and VA at 6 1/4. And as Jeff's going to do now, he'll pull up a copy or the chart of the 10-year bond yield for the last 5 days. And this is really kind of a holdover from last week. As you may recall, we had CPI, PPI come out recently. Both numbers were hotter than usual, and that's really what's pushed up the 10-year bond yield from where it was trading earlier. And I will tell you, though, that the good news is we've been at this level before, just 4 or 5 months ago, October, November. The 10-year bond yield actually got almost at 5%. We touched like 4.99. So believe it or not, while this feels like we've hit a high point, we're still about 0.3% lower than we were in October and December. So that's sort of the glass is half full view of things. And so what's going on? Why are we having this kind of continued elevation in the bond yields? Well, this week was kind of interesting. I mean, economic data point per se, not a lot of data points released this week, so a fairly light calendar. We did have some improvement in the bond yield this week on Tuesday when we got down to around 455. And that was because on Tuesday, the S&P U.S. Services and Manufacturing, PMI, that's Purchasing Manager Index, Both were below forecast and below the previous month. So that gave us a little bit of relief in this elevated bond yield situation. But that, yet on the other hand, durable goods came out and it was actually up 2.6% from 0.7 in February. But yet, if you exclude autos and planes from durable good orders, then it was pretty flat. And then the next data point coming up, well, actually, I'll point out today, which I don't have on the slide, GDP was announced lower than expected. GDP for the first quarter, only 1.6% growth. And that really took the stock market for a big sell-off, which normally you would think would help us improve bond yields for a couple of reasons. One is the 1.6% GDP number being weaker than expected. You would think that that would be encouraging to the bond market, a better indication the economy is slowing down. And, with a slower economy, as we talked before, that's usually good for bond yields. Plus the fact when you have a stock market sell-off, which at one point this morning was over 600 points down, that will sometimes cause a little bit of what we call the flow of funds situation where money comes out of stocks and into bonds. So, and yet today, with that GDP announcement, we actually saw a little bit of an uptick again in the bond yield. We were back under 470 yesterday, but we went up to as high as about 473 this morning. It's settled down a little bit now, about 470. I think what's going on there is the markets are looking at, oh gosh, on the one hand, GDP is weakening, but we still have hotter than expected inflation. And so the feared stagflation environment, I think, is what the markets are reacting to. The next data point that's going to come out this week, it'll be tomorrow, is the personal consumption expenditures, or PCE. Remember, this is the Fed's favorite inflation gauge. It'll be out tomorrow, and both the PCE and the core PCE, which of course core PCE excludes food and energy, they're both forecast to be flat from February. So we'll see if that's the case. If so, that should help us with this elevated bond level and hopefully get that bond yield down a little bit, which of course will translate into improving mortgage rates. I can't emphasize enough at the bottom of the screen, based on where we're at now, and also based on a recent presentation I saw last week, which I'll touch on in a minute here, on rates higher for longer. So, I know that may not seem like good news, but I think we're going to be at these elevated levels for some time. So any of you folks waiting for those, 3s and 4s and 5% interest rates, they're not on the horizon anytime soon. So I think you've got to embrace where we're at now and then utilize strategies to take advantage of how you can get into home ownership despite these rate levels. So with that, I want to go ahead and talk about, again, a presentation I saw last week, and it was here in the Coachella Valley. And it was a good presentation by someone, economist named Dr. Christopher Thornburg. He's a founding partner with Beacon Economics. And he does a presentation here in my market every year. And so he did that one last week. And by the way, I think I attributed or mentioned in a recent program of ours, as Jeff points out, I always say, beware the headlines. Well, Dr. Thornburg, I have to give him the attribution for that. I mean, he's the one where I first heard that term in last year's presentation. I really thought that was dead on accurate in terms of, how to think about all the news we see out there. And so, just understand that that's where I got that. So he starts this presentation with "out of the woods?" ? And of course, that seems like an appropriate question, right? Because we've gotten all this information that tells us we're in deep trouble from the economic standpoint. Well, his take was, we're not out of the woods because we were never in the woods. The economy's actually done pretty well. The economy has performed in a fairly strong fashion. And so first thing he pointed out then, after declaring, hey, we were never in the woods, things are relatively fine. He pointed out, of course, what for some of us who know anything about economics, excess demand causes inflation, not recessions. And one of the things he pointed out about what you see in the economy, what he sees as an expert, is that the higher rates that we've been seeing and dealing with have been offset by high liquidity and low private debt levels. I've certainly seen that in my market, high liquidity, there's all kinds of cash transactions out here in the housing market. It's remarkable how much money is floating out there. And it was interesting to hear Dr. Thornburg talk about private debt levels are relatively low, even though we recently have talked about credit card debt has exploded to the point it's over $1 trillion in the US in terms of aggregate total owed. Well, Dr. Thornburg's point on all that is, well, while we're seeing some increase in personal debt levels like credit cards, auto loans, et cetera, relatively speaking, it's such a small portion of the total economy, it's not been a major factor. And he also stressed that he believes consumer demand will remain strong, and that's going to keep the economy going. He then touched on California. And California, of course, that's where we're at. I do loans throughout the state. And his declaration about California is all the discussion and debate about, how good or bad the conditions are in California kind of misses the point. For example, with housing, he argued that housing really isn't about affordability per se in terms of, they're not affordable because of interest rates. He couldn't emphasize enough, it's all about housing supply. California's problem is lack of housing supply. That's really what's creating this affordability problem, if you want to call it that. So it's really more about housing supply, not so much about where rates are, generally speaking. And then also he argued that California should focus on revenue reform, not higher taxes. And I think part of the revenue reform issue is California's got a bit of a problem. Too much of the California tax base is based on very high income individuals. And there's sort of a gap between high income individuals that pay most of the income tax in the state and lower income individuals who pay sometimes little or no income tax. So there needs to be some sort of kind of reorganizing the tax base or more importantly, the revenue side of things to try to get it more evened out. He also argued that the state should be focusing on upskilling workers, not paying them more. He did have discussions about $20 an hour for fast food workers and so forth. His argument was we really need to focus more on getting workers more skilled. And that doesn't necessarily mean college. He talked a lot about trade schools, for example, and having more and more people look into trade schools, plumbers and electricians and auto mechanics and so forth, which are very high paying jobs. And then that could certainly help our situation. And of course, the other point he made was about California, and I think he was talking more about the California government, is, don't fix it. Just get out of the way and let things go, give people more freedom to kind of pursue these other points, and then things are going to get better. He did identify some risks: record federal deficits with no end in sight, and asset prices remain at pretty high levels. So he did point that out as a little bit of a concern, but overall, he was pretty optimistic. And lastly, in the real issue, as you see in the bottom right of the screen here in the yellow box, and this is where I borrow from him too, he says the narrative is running amok. He posted all kinds of news headlines about, talking about or describing the economy in deep trouble, blah, 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 when in reality, he just finished this presentation giving us all this data saying, hey, the economy is pretty good, not just in California, but nationally. And of course, he also touched on the fact that political chaos is in its wake. And one of the most interesting things he said during this presentation is, of course, we've all heard about food prices and, inflation in terms of, going to restaurants and fast food. And then, of course, that news article not too long ago where somebody posted that they bought a hamburger combination, hamburger, fries, and a soda for $25 at Five Guys. And like, oh my gosh, how can we, continue to deal with this? Well, despite all of that negativity, despite all those headlines, what did he point out to us? Restaurants in terms of, activity or how much business they're doing, 38% above what it was during the pandemic. So in other words, not only have restaurants recovered from the pandemic, restaurant sales are 38% above what they were before the pandemic. So isn't that interesting? Everybody's complaining about food prices. Everybody's complaining about how much it costs to go out and get a meal at a restaurant. And yet they're doing it. They're spending the money, which of course gets back to the other issue, which is there is more income, more liquidity out there than the media would have you believe. So anyway, this was a very good presentation. It was a little bit of counter to all the negative narratives. He had a relatively positive message about the economy, both in the state and nationally. And he basically argued that that should continue. He does not see a recession coming, and he does see rates remaining elevated for an extended period of time. So again, just understand this information. By the way, I have the PowerPoint that for his presentation. If anybody's interested, feel free to contact me. I'll be happy to send you a copy. So I thought this would be really good to touch on, to let you know that, again, beware the headlines. From an economic standpoint, things are actually pretty good, a lot better than the news media would lead you to believe. So with that, I want to go ahead and get into something that we're kind of starting to do every week because I'm so passionate about it. And of course, as you may remember from last week, the week before, I'm calling it buy downs are the bomb. And what I'm trying to do here is show you real life examples of what's possible if you embrace this strategy to buy a home, if you're still on the sideline about buying a home. So what I did here is I looked up a listing here locally in my market in Palm Springs. And here I'll describe, you can see on the bullet point, what the listing I pulled up: single family residence, single family detached home, featuring 4 bedrooms and 2 baths, 2,100 square feet with a pool. And it's listed in Palm Springs for $929,000. And what I noticed is it's been on the market for 22 days, been no offers, no adjustment in the list price. So what that means is that listing is approaching that point in time where they may have to make an adjustment, because usually if you don't get an offer within that first 30-day period, the market is giving you a signal you're not priced right. The listing did say, by the way, that the property was updated and remodeled. And I took a look at the listing, all the photos. That's definitely true. This is a very nice home. So what occurred to me is to, again, show you another example of what I see prospective buyers tend to do and what I think they should do. So next bullet point: what if you're a prospective buyer, you look at this listing, you like it, you want to go you want to go after it, you want to make an offer. Given how long it's been on the market with no offers yet, the typical scenario is a buyer is probably going to talk to their agent and say, all right, let's submit an offer. And we're going to submit $30,000 under the list price. So we're going to offer $899. And that's kind of an important emotional threshold anyway, under $900,000. And by the way, this buyer is, in my example, we're assuming that the buyer is going to be putting 25% down. So they're going to get a conforming loan amount. So in fact, at $899 purchase price with 25% down, you're looking at a loan amount of $674,000. Now, first thing to look at is, with that offer, $30,000 under list price and with 25% down at market rate, what's the principal and interest going to look like? Well, at 6 7/8, which, by the way, that was our rate a day ago when I prepared this, or 2 days ago when I prepared this. So we are up a little bit since then. But at 6 7/8, the principal and interest would be $4,428. Again, based on offering $30,000 below list, $899 offer price, $674 loan amount, $674,000 loan amount. Your principal and interest, $4,428. Now, what I always argue, and I continue to argue, is don't offer below list. In this case, consider a full price offer with a 3-2-1 buy down. When you do that, with 25% down, your loan amount is going to go higher. It's not going to be $674. It's going to be $696,000. Okay, so keep that in mind. So now, as we go to the next slide, what we're going to show you here is what that buy down would look like if you offered the full list price of $929. Well, the first thing, at the note rate of 6 7/8, the principal and interest would be $45.72. Now, make note of that number. On the previous slide, when I told you the other option that I see buyers tend to do more often is when they offer below $30,000 below the list price at $899, the principal and interest was not $45.72. It was lower. It was in the $4,400s. In fact, it was $144 less than this $45.72. So what that tells you is, if you offer $30,000 below list, yes, it will help your monthly payment a little bit, but only by $144 a month. In this case, if you're offering full price, yes, you have a higher loan amount at $696. Your note rate principal and interest is 45.72, but then look what happens. With the buy down, 3% the first year, your principal and interest is $3,273. That's $1,155 a month lower. So if you kind of do the math there, $1,155 a month lower the first year compared to your $144 a month lower if you offered $30,000 under list price. And the good news goes on. Second year at 4 7/8, your principal and interest is $36.83. That's $745 a month lower for that second 12 months. And then the third year at 5 7/8, the P&I is $41.17. That's $311 lower. And so if you total all that up over 3 years, that borrower, that buyer, if they are successful in getting an offer at full price and get the seller to agree to pay for the 3-2-1 buy down, which is what you should do, that buyer will save over $26,000 in payments over the first 3 years. That's a much better outcome than just offering $30,000 below list. And yeah, you save $144 a month versus a full priced offer without a buy down. But $144 a month over 36 months, that's not that much money compared to over $26,000 in savings using the buy down. So this is another example of how a temporary buy down at full list price features superior payment terms over a lower price offer. You need more reasons why you should consider this and why I say buy downs are the bomb. Well, guess what? Another data point that just got released recently, I think it was for the month of March, new home sales. They're up 9%. In fact, they're up as high as they've been in like a year and a half. Why? Because builders piling on incentives. And guess what? One of the core incentives that builders are offering, temporary buy downs, both 2-1 and 3-2-1. Another reason to consider buy downs are the bomb and why you should try to use one now and get into home ownership. Dave Ramsey, our friend Dave Ramsey, he was in the media again recently saying his next prediction, he predicted this a couple of years ago, he's doing it again. He says home prices are going to go up further. He doesn't buy into the notion that when and if rates fall, that home prices are going to start to fall because of more inventory. He says that's bunk. Home prices are going to go up, kind of like Barbara Corcoran, right? We've talked about her as well. She says the same thing. When rates go down, home prices are going to go up further. They're not going to go down. The key mantra there is date the interest rate, marry the home. So Dave's attitude is get into home ownership now so you can marry the home, take advantage of those increasing values in homes going into the future. In the meantime, date the interest rate for now, get the rates that are available now. I recommend using a 3-2-1. Then over that next 3 years, look for that opportunity to refinance. That means, of course, you're divorcing your existing rate and then getting a new rate that you'll date for some period of time until the next refi opportunity. And then finally, Fannie Mae recently came out and said, oh, we're going to revise our forecast. We think now higher rates will linger longer due to these latest hot inflation numbers that seem to be lingering for the last couple of months. So again, this is a very good concrete example of how a temporary buy down is a superior way to pursue home ownership. And if anybody's interested in this particular property, call me, send me a text, email me. I'll be happy to send you the listing and be happy to put some numbers together for you in terms of doing a temporary buy down, whether it's a 2-1 or a 3-2-1. So that's this week's example of buy downs are the bomb, a real life example using a real listing here in my local market. Keep this in mind. And if you're interested, let me know, give me a call, send me a text or an email, and I'll help you put the numbers together. So with that, I want to go ahead and go into our next subject. And I thought of this because, you might recall a couple of weeks ago, I highlighted an article, one of those articles that says, I'm a real estate agent, and here is the best time of the month to close your loan. And I evaluated that. And if you recall, I pretty much, suggested that was a little bit overdone. I kind of used the 6 1, half dozen the other comparison that, timing your purchase loan for the end of the month doesn't really net save you any dollars. It's really just a cash flow thing. But that got me thinking, is there a type of a transaction where timing the closing of your loan at a certain time of the month, is there a real benefit? And what I concluded is yes. it's a refinance. So again, you see that my headline here, say what? Skip 2 monthly payments when refinancing your mortgage? Yes, that's possible. Let me show you how that works. First thing I'll tell you is, and again, this is talking about a refi, not a purchase. On a refi, I would argue the best time to close your refi is right around the 10th to the 12th of the month. And why do I say that? Well, the first thing is on your existing mortgage. That existing mortgage has, as you probably all know, if you own a home and have a mortgage, it has a 15-day grace period. So what that means is your mortgage is due on the 1st, but they give you 15 days to make that payment without triggering a late charge. So you basically have until the 16th, and you won't be charged a late charge. So understand that particular point. Now, here's the next point. It's a little harder to follow. When is the first payment on the new loan that you're getting? Well, the first payment on a new loan is going to be 30 days from the 1st of the month following the month you close. Let me say that again. 30 days from the 1st of the month following the month you close. Example, we're in April right now. If you close a loan basically any day in April, your first mortgage payment on that new loan is going to be June 1, not May 1, June 1. So you're going to skip a May 1 payment. Why is that? Because mortgage payments pay interest in arrears. So that June 1 first payment pays the interest that's due from May 1 to June 1. So that's why your first mortgage payment is always 30 days from the 1st of the month following the month you close. So then if you take into consideration the 15-day grace period on your existing loan, and then realize that when you close your mortgage in a particular month, we're using April in this example, if you close the loan this month, you're not going to have a payment on the new loan until June. Then how does closing between the 10th and 12th of the month help you skip 2 payments? Well, it's because if you do close by the 10th, 12th of the month, and I put that as a range, because when you close at that point, then that refinance loan, when it closes, is going to involve a disbursement to your existing lender to pay off your existing mortgage. And that way, if you close between the 10th and the 12th, that payoff should hit your existing mortgage lender and get it paid off by the 16th, 15th, 16th of the month. So that way, you would be able to get that paid off and not trigger the late charge. But also, you can choose to skip that April 1 payment. Why? Because if you close by the 10th, 12th of the month, the payoff statement that we'll get from your existing lender will take into account the interest that is due when you haven't made that April 1 payment. And then the idea is by closing on the 10th or 12th, you're therefore able to skip that April 1 payment because it's accounted for in the payoff amount that's issued by your current lender. And then because you're closing mid-April, your first mortgage payment is until June 1. So voila, you've skipped April payment. You're skipping May anyway because your first payment on your new loan is until June 1. So there you have it. You've skipped 2 monthly payments. So it's a little trick of the trade. Whenever I do refis, I always point this out to folks so that they understand that they have that opportunity. And by the way, one other little caveat to this, if your existing mortgage has has an impound account for taxes and insurance, one thing to be aware of is you'll have a nice little surprise coming to you in the mail after you complete your refi, pay off your existing loan that had that impound account. Whatever money was residing in that impound account that didn't get used by your existing lender being paid off, that money gets refunded to you after closing. Usually get it somewhere around a week, 10 days after closing. And a lot of times homeowners are pleasantly surprised when they get that check. I always try to let them know ahead of time that that's going to be happening. But just understand that's another little benefit of doing that refi and paying off an existing loan with an impound account. So there's the trick. On refis, yes, I do argue there is a good time of the month to close. So keep this in mind. And if, by the way, you're interested in a refi, let me know. I know there's not a lot of them out there, but in some situations, it still makes sense. Okay, with that, I'm going to go jump right into our closing question from last week. And this is one that I would say creates a lot of frustration with home buyers. And again, this is having to do with a purchase loan. When we got the loan for the house we currently live in, we had to jump through all sorts of hoops providing documentation of our escrow deposit, even though the lender had already verified our deposit with escrow. Why is that? Well, what I thought I would do is first show you directly out of the Fannie Mae Seller Servicer Guide. Here's what Fannie Mae says about your escrow deposit. The bank statements must evidence that the average balance for the past 2 months was large enough to support the amount of the deposit. If a copy of the canceled deposit check is used to document the source of funds, the bank statement must cover the period up to and including the date the check cleared the account. So that guideline can be sometimes a little challenging to meet because almost every purchase money loan approval is going to have a condition to provide proof that the borrower's escrow deposit had vacated or exited their existing bank account, whichever one they used to provide the deposit. And what this can do is create what I call an account statement cycle / account transaction history dilemma. Well, what the heck does that mean? Well, first thing is understand that with a purchase transaction, you have a time period, you have a close of escrow date. And sometimes, depending on the timing of the month when you start your transaction, you may be giving that escrow deposit, whether by check or by wire. These days, it's more often done by wire. It could be that you will not be closing on a date where you're going to get your next monthly statement from the typical monthly statement cycle. In other words, transaction close date may not allow for the next statement cycle. With some bank accounts, the statement cycle is monthly, calendar month. An April statement covers April, a May statement covers May, and so forth. That's more often true with business accounts. With personal accounts, monthly statements are usually for 30 days, but they can have starting and ending dates kind of mid-month, like mid-April 15th to May 15th, that kind of thing. So the challenge is if you're having to provide, which you will be, evidence through a bank account statement that your escrow deposit that you gave to escrow, that we have a copy of. Typically, escrow gives us a copy of the check or the wire in that they received, and then they issue us a receipt to show that they've received the money. But because we have to show the money coming out of your account, and if your transaction is going to close before the next statement cycle has finished and the next monthly statement comes out, then you've got a problem. So how do you prove it came out of your account? Well, you have to then pull an account transaction history for that account. What that means is hopefully you've got online banking. So you'd have to go online and pull an accounting, a transaction history with a date range. And this is what trips people up. First of all, what I've noticed is even people who have online accounts aren't really necessarily that kind of privy to how to pull either a monthly statement from their online website with their bank, and pulling transaction histories can be really challenging for some borrowers. The reason is for a couple of things. One is you have to have the proper date range. If you're going to be closing your purchase loan on a date before your next monthly statement has been issued for the account that you paid your deposit from, then what you have to do is go online to your account, pull an account transaction history. It's important that the date range be proper. The date range has to be the ending date of your last issued monthly statement up to present time. So very important. It's got to be a date range from ending date of your last regular monthly statement that was issued up to present time. There can be no date gaps. Sometimes I'll just get a snapshot of, basically of just one date when the money left the account and without the date range. That'll get rejected by the underwriter. They need to have a date range from the date of the last monthly statement to present if you're going to have to pull an account transaction history to show the escrow deposit coming out of your account. The other area where we run into problems when people try to provide an account transaction history is it does have to have adequate identifying info, such as your name, the account holder's name, the bank name, a partial account number, or the URL printed at the bottom of the page or sometimes top of the page. So it has to have the account and transaction history I'm talking about. It has to have adequate identifying history. I've gotten account transaction histories from borrowers that have looked great, but there's no identification information at all. The borrower's name's not on it. The bank name's not on it. There's no URL. It just looks like it was done on a Word document. It all looks nice and pretty and even got the proper date range, but without any identifying info, the lender's underwriter is going to reject it, because how do they know it's for you, for your account? It could be anybody's account. So that information is important. So these are some of the reasons why when you're buying a home and you pay your escrow deposit, we're going to make you go through a few extra steps to show that money exiting your account, as well as the fact that we've already verified that it was received by escrow, because escrow has given us that piece of the deal. So going through these steps, which I know can be tedious, sort of closes the loop. The idea is Fannie Mae is looking to make sure that the borrower is using all of their own money to close the transaction, including their escrow deposit, and to make sure that, in particular, the seller is not on the side trying to help the buyer because they're short of funds and they got some side deal worked out where the seller's going to try to help them out. That's not allowed. So that's the reason you go through all these hoops. So I hope that makes it a little bit more, at least understandable why it happens. It doesn't make you necessarily any happier that you have to go through these kind of steps, but that's just the nature of the business. And with that's a good question, by the way. We run into it daily, and just understand that's just a fundamental part of the process, because the rule maker, Fannie Mae, that's what they want to see. And with that, I'm going to go ahead and jump into our closing question for next week. And this was funny because I got a message from somebody, and this is exactly what this person said. So I thought I'd just put it out there. It's not a new subject. It's been a burning question in the mortgage industry forever. So here's the question. Okay, I still don't get it. Tell me again, what the heck is APR? So I chuckled when I got this message. I thought it was a very good question to cover this for next week. So there you have it. Stay tuned next week where I'll give you the answer, and it'll be on the house. Thanks. And Jeff, back to you.
Okay, sorry about that little technical issue on my side. Again, I'm working without a mouse, and it's amazing. It's almost like running or hanging wallpaper, and you only have one arm, so it's pretty tough. Anyway, right. Hey, what a great show! A lot of good information there. That whole thing about the proof of the deposit being in there, or that was interesting, because I have personally dealt with that. I'm like, well, you got my bank statements. No, that's not what we need. Okay. Yeah. So, I was one of those guys who are like, okay, yeah, I did know how to do that transactional history, but I didn't understand what the purpose was when I said, hey, one shows it's coming in, the other one shows it's going out. What's the deal? And right. So it was one of those things. So always a great show, Art. I just have one question. The first presentation portion you talked about with, hey, we're not out of the woods because we're not even in the woods. What's your forecast here for our local area? What's your 30-second headline there?
Well, I didn't touch on that. We do have an audience that goes beyond the Coachella Valley, but a pretty significant portion of Dr. Thornburg's presentation, and the reason he does this out here every year, was a more specific focus on Riverside County, or Inland Empire, as we call it, Riverside, San Bernardino, so forth, and the Coachella Valley. And he was even more positive about our local market. Relative to California as a whole, Coachella Valley, Riverside County, San Bernardino County, the economy is quite good, very strong. He sees no let up of that. We are in his opinion, a very good, location, if you will, in terms of economic activity. He sees no end in sight anytime soon. So he was very, very bullish about our local market here in the Inland Empire, Coachella Valley, Riverside, San Bernardino County. He was very bullish about it.
Well,
and I think he's right. I agree. There's a lot going on here. So.
Yeah, I mean, just we think about the period of time, but like here in the Coachella Valley, the Acrisure being built, 2 years. It was in the middle of the COVID, and yet it's doing very, very well. New things after new things, and I just seem like it's just no end in sight, which is good. And you see the restaurants. You're thinking with the prices going up, you'd easier to get in. It hasn't changed. It seems like it's harder to get into the restaurants rather than easier. So I
Well,
think you're spot on.
well, yeah, it kind of goes back to a few programs ago where I threw out that my little quote about, mortgage rates and, you know, only in America will people go out and put $200 on a credit card at 22%. And I'll say complain about a 6.5% mortgage. Um, his data about, hey, guess what, folks? Yeah, you're all complaining about $25, Five Guys cheeseburgers, but you're complaining about it, but you got the money and you're buying them because the restaurants are doing 40% better than they were before the pandemic. It's like, that doesn't make any sense. I mean, that shouldn't be happening, but yet it is.
Yeah, it's pretty wild. And I sent you a screenshot of a credit card that I had just finished paying off when it was 0% interest, and they sent me a little love note that said now the interest rates. I think it was starting May 1. We're going to go up to 34.99. I'm like, yeah, I'm not going to use that credit card.
Yeah,
It's
yeah. I
crazy.
mean, can you imagine 35% on it? I mean, that's just, you're not going to get wealthy borrowing money at that level. You're just not.
No, maybe I should start lending money. That would be the case. So, anyway,
Well,
I'm not
and
going to
one
get
of
into
the things,
that. Go
well,
ahead.
one of the things that the economist from National Home Association of Home Builders at lunchtime pointed out was, in terms of home ownership, I mean, yeah, rates are high, but at least it's an asset. And it's like, why would you borrow money at 35% for anything on a credit card? Chances are you're going to be purchasing something that's not an asset that's going to appreciate. Well, heck, even at a 7%, if you can finagle a way to buy a home, even at that rate level, you're getting an asset that's very likely, and by all observers' indications, that's going to go up in value. So,
Yeah, it's a good deal. So your information is on the screen, Art. It's MortgageWorks, 760-883-5700, or your cell at 714-612-9035, which I think I heard going off in the background. We do have people
yeah,
watching the show today. They probably said, hey, I need to get involved in this and get some help. So the
yeah.
website is mwloan.com. You saw earlier, that's where the rate chart is. There's also an abundance of tools below that. And of course, you can always email art@mwloan.com. He is the place that you want to go to. And when anything, whether it's reverse mortgages, first loans, refinance, the 3-2-1 buy down. I mean, I hear they are the bomb. And
There.
I love that section, quite frankly. That's my most
Yep.
favorite section because it's just amazing to see how much money people can save by buying now, and you're not even talking about. I mean, you haven't even added in the point of, hey, there's appreciation on the value of your property. So this is
Right.
this is unrealized gain. That maybe you should put that in there somewhere too at some point. But
Yeah, good
that's
point.
pretty slick. All right.
Yep.
Well, with that, Art, I'll let you go. Have a
Okay.
great week. And again, if you have questions, please put them in the comments. Art will respond to them and get you an answer. Make sure to call Art at 760-883-5700 for all your loan needs. That's throughout the state of California.
Yep. Thank you, Jeff. Thank you, everyone, for watching and listening to this week's Mortgage Minute. Hang in there on rates. We're going to be okay. In the meantime, stay tuned next week where we'll have another edition. I'm Art Alvarez at MortgageWorks, where we have the answers and they're on the house. So long. Take care.